Warren Buffett once made a $1 million bet that the S&P 500 would outperform a collection of hedge funds over a decade. Spoiler alert, he won handily. While past performance doesn't guarantee future results, this anecdote highlights why many investors worldwide seek exposure to the S&P 500. But for Singaporean investors, there's a smarter way to access this market than the options most Americans use, and it could save you thousands in taxes over your investing lifetime. Important disclaimer. This video is for educational purposes only and does not constitute financial advice. The perfect storm. Market correction meets trade war. The S&P 500 has officially entered correction territory, falling over 10% from its February peak. Wall Street was rattled yesterday as fears of an escalating trade war overshadowed positive inflation data. The European Union's 50% tax on American whiskey exports prompted threats of 200% tariffs on European wines and spirits from President Trump, sending markets into a tailspin. As one market analyst put it, "Sentiment's terrible. There's new tariff headlines every day, and that's weighing on things." This uncertainty has hit tech stocks particularly hard, with the Nasdaq tumbling nearly 2% in a single session. But here's where smart investors differentiate themselves from the crowd. They see market corrections as potential opportunities rather than reasons to panic. Understanding CSPX, your tax-efficient gateway to U.S. markets. The iShares Core S&P 500 UCITS ETF ticker, CSPX, isn't just another S&P 500 tracker. It's specifically structured to benefit international investors like Singaporeans. Here's what makes it special. Ireland domiciled for tax efficiency, and Singaporean investors are US domiciled. ETFs like VOO or SPY, they face a 30% withholding tax on dividends. However, CSPX is domiciled in Ireland, which has a tax treaty with the US that reduces this to just 15%. That's potentially doubling your dividend returns over time. A quick calculation: if the S&P 500 yields 1.5% in dividends annually on a $100,000 investment, that's $1,500. With a US ETF, you'd lose $450 to withholding taxes, but with CSPX, you only lose $225, saving $225 annually that can compound over decades. Accumulating structure. The compounding machine. Unlike many ETFs that distribute dividends, CSPX automatically reinvests them. This creates a powerful compounding effect over time and simplifies your investment management. No need to decide what to do with those quarterly dividend payments. Protection from U.S. estate tax. Here's something many investors overlook. U.S. domiciled assets over $60,000 can be subject to U.S. estate tax rates up to 40% upon death. CSPX, being Irish domiciled, shields Singaporean investors from this potential liability. The numbers behind CSPX. Let's look at what you're actually investing in. Fund size: 104,545 million euros, approximately 113 billion United States dollars. Expense ratio: a competitive 0.07% PA. Top holdings: Apple 7.61%, Nvidia 6.74%, Microsoft 6.31%, Amazon 4.14%, Meta 2.57%. Sector allocation: technology 35.07%, consumer discretionary 11.47%, financials 10.66%, healthcare 9.85%. Performance: plus 113.11% over 5 years, plus 623.17% since inception. In 2010, the tariff dilemma. Understanding the economic context. Recent polling reveals fascinating insights into Americans' views on tariffs. According to a Reuters Ipsos poll conducted March 11 to 12, 2025, among Republicans, 58% believe higher tariffs are a good idea even if prices increase. Among Democrats, 87% disagree with this stance. Overall, 53% of Americans believe increasing tariffs will do more harm than good. This political divide reflects the complexity of trade policy. While tariffs can potentially protect domestic industries and workers, they often lead to higher consumer prices and retaliatory measures from trading partners, as we're currently witnessing. Producer Price Index (PPI) data released yesterday showed cooling inflation, which would typically be positive news. However, Concerns about tariff-induced inflation potentially derailing the Federal Reserve's rate-cutting plans have overshadowed this data. How Singaporean investors can access CSPX. There are several platforms available to Singaporean investors looking to purchase CSPX. 1. Interactive brokers IBKR Pros. Lowest overall trading fees, accessed to multiple exchanges where CSPX is listed, fractional shares available, global market access. Cons. Steeper learning curve for beginners, limited local support. 2. Saxo Markets Pros. User-friendly platform, local Singapore presence and support, access to multiple exchanges, transparent pricing. Cons. Higher trading fees compared to IBKR, higher minimum investment amounts. 3. FSMOne Pros. Simplified user experience, access to London Stock Exchange where CSPX trades, research tools and market insights, local Singapore support. Cons. Generally higher fees than IBKR. 4. Syfe Pros. Competitive pricing, 99 cents per trade, fractional shares available, user-friendly interface, ideal for beginners, auto-invest feature for dollar cost averaging. Cons. FX spread may be less favorable, limited exchange access. Strategic approaches for today's volatile market with current market conditions in mind. Consider these approaches. 1. Dollar cost averaging, your market timing buffer. Instead of trying to time the market perfectly, which is nearly impossible, consider investing a fixed amount regularly, perhaps monthly or quarterly. This approach means you automatically buy more shares when prices are lower and fewer when prices are higher. A $1,000 monthly investment during a market correction means you're potentially buying the dip and lowering your average cost basis over time. This strategy helps remove emotion from the equation. 2. Long-term vision. The power of patience. While market corrections can be unsettling, they're a normal part of investing. Historically, the S&P 500 has recovered from every correction and bear market it has faced. Consider this. If you had invested in the S&P 500 at the worst possible time, right before the 2008 financial crisis, you would still have more than tripled your money by 2025, assuming dividend reinvestment. 3. Core satellite approach. Balancing stability with opportunity. Consider using CSPX as a core holding representing 60 to 80% of your U.S. equity exposure, while potentially adding satellite positions in sectors or regions you believe may outperform. This approach provides both stability and the opportunity for outperformance. 4. Currency considerations. The USD factor. Remember that as a USD-denominated ETF, there's currency risk from SGD-USD fluctuations. This can work for or against you depending on exchange rate movements. Some investors view USD exposure as a feature rather than a bug, providing diversification away from the Singapore dollar. Real-world impact. How this investment strategy could work. Let's consider hypothetical scenario. A 35-year-old Singaporean investor decides to invest SGD 1,000 monthly into CSPX through interactive brokers. Assuming an average annual return of 8% below the historical average, but accounting for potential volatility and a 30-year time horizon, total invested, SGD 360,000. Potential future value, approximately SGD 1.5 million. The power of compounding, combined with the tax efficiency of CSPX, makes this a potentially powerful wealth-building strategy. By saving that additional 15% on dividend withholding taxes and automatically reinvesting dividends, the investor's returns are optimized. The risk perspective. What could go wrong? No investment discussion is complete without addressing risks. Market risk. The S&P 500 could underperform for extended periods. Currency risk. USD weakness against SGD could reduce returns for Singaporean investors. Concentration risk. While diversified across 500 companies, CSPX is still focused solely on U.S. large caps. Regulatory risk. Tax treaties or rules could change in the future. Diversification across geographies and asset classes remains important. CSPX should be part of a broader investment strategy, not the entire strategy. Why this opportunity matters now. Market corrections, while uncomfortable, often present buying opportunities for long-term investors. With the S&P 500 now officially in correction territory, price-to-earnings ratios have become more attractive. The current correction, triggered partly by trade war concerns, doesn't change the fundamental innovation capabilities of American companies or their global market reach. The S&P 500 includes many of the world's most innovative companies with substantial international revenue streams. Cooling inflation data suggests the Fed's rate-cutting cycle may still proceed as planned, which has historically been supportive of equity markets. While tariff concerns are valid, patient investors who maintain discipline during volatility have historically been rewarded. Conclusion: strategic patience in turbulent times. For Singaporean investors looking to build long-term wealth, CSPX represents a tax-efficient vehicle to gain exposure to the world's largest economy and some of its most innovative companies. The current market correction may provide an attractive entry point for those with the discipline to look beyond short-term volatility. Remember that investing is a marathon, not a sprint. Market corrections and even bear markets are normal parts of the investment journey. By focusing on tax efficiency through vehicles like CSPX and maintaining a disciplined approach to investing, Singaporean investors can potentially build significant wealth over time. Again, this is not financial advice. Every investor should consider their own financial situation, goals, risk tolerance, and time horizon before making investment decisions. Always do your own research or consult a financial advisor before investing. What investment strategies are you considering in today's volatile market? Let me know in the comments below, and don't forget to subscribe for more insights on international investing strategies.